Okay, I think we might actually be on. We might be up and running. Let's give it just 1 minute. If you are there and you can hear us, please drop hashtag coffee break into the chat. And I think we're going to get going. So away we go. And welcome everyone to the Construction CPA's Coffee Cafe. I am Lisa Raish. I am the Construction CPA. We are dropping the hammer on cash flow problems for contractors so you can build things that matter. And this week's topic is tax planning strategies for year end and beyond. And I know we've been talking about tax pretty consistently over the last couple of weeks. It is a pretty important topic. It becomes a very important conversation point as we move closer to year end. Again, you want to, like anything else, you want to do all your planning in advance. I would not recommend waiting until year end, but this is a good time to reevaluate any strategies or any opportunities that you may have had throughout the year. Review anything that you had in place, make sure everything is actually in place. You've documented everything that you want to document. You funded everything that you need to fund as you get closer to year end so that you don't worry that you haven't kind of dotted your I's and crossed all of your T's to put all of your tax savings opportunities into play. And the other thing is that year end is a great time to kind of look ahead now to the next year and start to put any strategies in place so that you can take advantage of them throughout the year. And again, you're not scrambling at year end to, for an example, funding retirements all at once at year end. It tends to be a lot easier from a financial perspective and a cash flow perspective to work throughout the year and fund throughout the year. So again, we're going to talk about a number of these different things as we work through, but really, why is it important? You want to be able to not only build your business's finances, but you want to be able to build your own personal finances, and you want to be able to afford the things that you want. So if you're able to anticipate what your tax liability is going to be, or reduce your liability, you can in fact now begin to save more and build more personal, we'll call it personal wealth for yourself, versus having the money go to the IRS or to the state tax, or in some cases, there are some local governments. If you're in some of these states, there are your localities that you're paying taxes to. So really, can we find ways to put more money in your pocket so that you can save it for a rainy day, that next big trip you want, or long-term for your own overall long-term wealth, and then into retirement? So it becomes important to really think about it, especially at year end, and review, like I mentioned, review what you have already determined that would be tax saving opportunities for you. And this is something that you should be doing throughout the year with your tax professional, whether it be your CPA or your EA, any one of them that are doing your tax prep. You want to be doing that planning with them in advance. So year end really is that time for you to look to see where you are with all of your strategies. Have you done with what you're supposed to do? Have you documented all of them to ensure that you have everything in place at year end? So important dates. Keep in mind, December 31 is an important date. And yes, it is year end, but it's also important, especially when you're looking to put certain things into play. For example, things like retirement options. Most cases, you need to have the actual plan in place prior to the close of the year. Depending on the type of retirement option you have, for instance, if you're in a SEP, or if you are in a solo 401k or something to that extent, you want to have, or you need to have, that document in place prior to the close of the year. There tends to be additional extensions of time on the ability to fund it related to a specific year. Each plan has its own rules, so you want to make sure you're aware of those rules. But typically, if the plan itself is not created before the close of the year, you cannot go back and fund on behalf of that year. So keep in mind, December 31 is a very important date. The next, everyone is aware, April 15 is going to be the date to file your tax return. There are some people who take that April 15th and utilize it and apply for an extension. It is an extension of time to file. It is not an extension of time to pay. So you should be paying your entire or your estimated tax liability when you file your extension. But April 15th is an important date as well. Like anything else, you want to be prepared. If you are prepared in advance, then you'll have the information. You're not scrambling for it. You have the ability, if you plan ahead, to change course. Something may happen through the year that changes maybe a strategy that you thought you would be able to utilize at the beginning of the year. Maybe you can't at this point. Or again, the government may come out with a new tax savings opportunity, and therefore now you can utilize that one. If you're planning throughout the year, you have the ability to change course and potentially maximize on other opportunities that may come up. Like anything else, you want to be proactive. You want to have options. The only tax option that you have in January for the prior year is to pay your taxes, nothing else. And you don't want any surprises. You want to have an idea of what your tax liability is going to be as you work throughout the year. So when you're having your quarterly conversations with your CPA or your EA about your tax picture, you're not surprised when that return is filed in the next year, because you knew based on the conversations that you were having with your preparer throughout the year, and you're doing planning around what you think that liability is going to be. So let's talk a little bit about deductions and credits, because they aren't the same thing. So deductions is going to be an amount, or a deduction is going to come directly against your taxable income. You want a deduction that will reduce your taxable income. For example, when you hear people say the standard deduction, it is a deduction that's going to reduce your taxable income. A credit really is a dollar for dollar reduction of your tax. So the child tax credit is going to be a credit that you apply against the overall tax liability that you have calculated. So your deduction reduces your taxable income to get that taxable income number down, and your credit truly reduces the total dollar potentially due for your tax liability, because it's a reduction of that tax. So we've talked about it before on other lives. I chatted a little bit about it earlier. Retirement contributions are a great way to reduce your tax liability. There are a number of different options. It's going to depend on the type of business you have. Do you have employees? Do you not have employees? How is your entity structured? Are you an LLC operating as an S Corp? Are you a sole proprietor? Again, the options are going to be different. The contribution limits are going to be different. So make sure that you are having the retirement conversation with your CPA and your EA so that you can determine what opportunity is the best for you. The other thing you want to think about too with retirement is having the conversation with your financial planner to understand how that overall retirement planning flows into the long-term financial plans they're creating with you. So we feel it's very important to have a relationship with our clients' financial planners so that we understand when we are creating tax savings opportunities for them, that we understand what their overall long-term financial goals are, so that we can help them not only maximize at this moment, but understand how it could potentially affect them as they get older, as they get closer to retirement, as they get into retirement. Another great way, another great deduction is charitable contributions. You need to make your charitable contribution to a qualified 501c3. Not all of those are created equal, so you need to be careful. You also want to make sure that you retain documentation of that expense. For example, most of these contributions that you make, you're going to receive something from them, either an email thanking you for your contribution, or maybe some are still sending them in the mail. You want to retain that for your records because you need to be able to prove those charitable contributions. So it's a twofold. If you're writing a check, you want to keep a copy of that check, but then also you want to retain whatever documentation that you receive in exchange from the 501c3, thanking you for your contribution. More of us are doing online contributions. So typically you're going to get a thank you email right away. You want to save that thank you email as proof that you made that contribution. And the last thing, or not the last thing, but another thing that's really important is capital gains and losses. There are ways to kind of strategically think about how to manage them. You may want to, in certain years, kind of what they call harvest your gains and your losses. So you may have sold something and you have capital gains coming out of that. But if you're looking to reduce your overall tax liability, do you have something that you are holding right now that you're holding at a loss? So when you hear someone say, harvesting, it's okay, we have a gain. Where else do we have a loss that we could potentially take to offset that gain? I will say that would be, that's a conversation that you need to ensure that you're having with whomever helps you, your financial planner, any kind of, broker that you work with. Make sure that you're working closely with that individual to ensure that you are using it appropriate, that you are kind of pulling on the right things at the right time. Get the advice that you need when you are looking to kind of harvest your gains and your losses. Talk to your financial planner. Don't just go off and do it. Have a conversation first, because there also may be a long-term reason why you have certain investments. So you don't want to just sell an investment that you have a loss at just because you want to offset the gains. There may be an overall long-term reason. So again, it's all part of an overall long-term planning. It's not just planning this year, but it's long-term life planning. So with anything else you're going to want to do, we do business planning with our clients, but we do business tax planning. So we're looking at ensuring that we can maximize their ordinary and necessary business expenses and taking all the deductions that they can in a given year within reason, of course. So is there an ability to, again, a lot of times you'll see for a deduction, in construction, buying equipment tends to be one of the larger kind of tax saving levers we tend to pull on. So can you purchase something? And it doesn't have to be at year end. It might be something, because you've done your business planning, that you've actually planned and you've purchased this asset throughout the year. So again, maximize the overall expenses you have in your business in a given year so that you can reduce your tax liability. There may also be an ability to defer income into the next year versus taking it in this year. So that's something to consider as well when you are looking at your business. Is there a reason, or is there an ability to potentially wait to invoice a client in the early part of the next year, on January 2 versus on December 28th? They may not pay you right away, but again, can you kind of move some of that income into another year? Can you defer, again, if you're cash basis, cash in, cash out? If you invoice a client later on in the year, there's an expectation they probably wouldn't pay you until the next year. So is there an ability for you to kind of move some of that income around? Those are just things that you want to think about. And like anything else, you want to review all of your business expenses, any investments that you make, especially at year end. It's a good time to kind of take an overview, a big overview snapshot picture of what's going on, just to make sure that you're kind of moving in the direction that you would like to be moving in. So every year there's typically changes that happen every year. Some are more dramatic than others. So there's going to typically be inflation adjustments on an annual basis for things like mileage. So the mileage rate may go up. Sometimes it does come down if the rate has gone up significantly. For instance, probably maybe 10 years ago, if memory serves me, the mileage rate went up significantly in the middle of the year, but in the next year, because gas prices had come back down, the mileage rate came back down next year. So for the most part, rates typically will go up. Mileage is one that may potentially go down, but for the most part, rates or your inflation adjustments are going to be created for mileage. For the standard deductions, those will typically go up. The retirement savings, the limitations will go up as part of the inflation adjustments. Energy credits, those will potentially adjust as well, especially any of the clean vehicle energy credits that are out there. As more and more of the clean vehicles go into production, the overall ability or the rates or the credits available as there are more and more of them out there start to get smaller. So something to think about as well. And then your tax brackets may potentially change. So the dollar amounts may change, may spread out to change for inflation. The actual percentage rates have not changed in a little bit. But your actual dollars, the bracket dollars, may potentially go up due to inflation. So those are the things that you want to look at. And the biggest thing that you want to make sure that you do is you want to plan. And if I say nothing over and over again, it's plan, plan, plan. If you don't plan, then in many cases, you don't get options. If you don't plan, you're left with one option. So do your planning in advance. It allows you to be proactive. It allows you to make adjustments for things that have happened during the year that may affect what's going on in your business or your life or both. You want to make sure that you are managing and maintaining your documents. You're keeping your financial records organized. You don't want to try to organize all your financial documents in January for the prior year. Keep them organized throughout the year. Do you have a document management system? If you do, many of you in your businesses, you have some sort of document saving system, whatever that is, whether it's electronic. Some of you still may maintain paper file cabinets. That's okay. But just make sure that you maintain documentation to support your deductions, the reasonings behind credits, and so on, because those, you proving them, should you be in front of a tax authority for an audit, is your responsibility. You have to prove the deductions, the reasonings behind the credits, and so on. So it's your responsibility to maintain. So, keep good records. Like anything else, you want to maintain good records. You want to keep your personal separate from your business. You don't want to commingle them. You run into challenges with your business if you start to commingle your personal expenses with it. So you want to keep them separate. You still want to maintain the documentation for both your business and your personal. Just like anything else, you could potentially use the same document management system. You just want to keep all of your expenses separate. Keep up to date on what your obligation for tax may be. That's the reason why you want to have that conversation with your CPA or your EA on a quarterly basis. Where do I think my tax liability this year is going to fall? For many of our clients, they are in pass-through entities. So we are looking at the profit coming out of their pass-throughs and looking to see how that's going to affect their overall tax liability. So instead of surprising somebody in March with a tax return, have that conversation with your tax people throughout the year on a quarterly basis so that you can at least gain an understanding of what you think your overall obligation is going to be for the year. And last thing, like anything else, back up your data. If you are maintaining electronic systems, we do everything we have here is electronic. You want to make sure that you're backing that up. You don't want to lose your data. So save it in a couple of locations. If you do maintain paper file cabinets, and there is nothing wrong with that, you do want to make sure that you have a way to protect that information. So you may consider scanning that information as well. Paper can be damaged by fire or water, or over time, paper does tend to degrade, depending on if it's stored maybe in a basement or an attic. You take the chance that the paper itself degrades. So just consider, if you are still maintaining paper records, you want to think about potentially saving that information also in an electronic format, just to have a backup. And, you know, you want to be proactive throughout the year. You want to reach out and have that conversation with your tax person on a quarterly basis. That's where you have the ability to learn about new tax laws or changes that may have come into play up to that point that may affect your business or your personal, or things that you may be able to utilize from a tax perspective for that year. When you're having those proactive conversations, it's not a reaction in March where you have very limited options at that point. You have the ability to get ahead of it and make decisions, because when you are doing a lot of business and personal things, in many cases, you need to think about what you're doing at what time. For instance, are you going to sell a business, or are you going to sell a piece of real estate? How does that affect your overall tax picture? So when you're looking at that proactively, it's not just something that's thrown on you and this is the only option I have. You're looking at it in advance and saying, in the next 2 years, I expect that I'm going to sell my business. What could that potentially look like? What could a sale look like? Also, the other thing to think about, as we all have aging relatives, there may be inheritance of family assets, family retirement plans, things like that. So you want to understand how that does or does not affect you, by not only having the conversation with your tax professional, but having the conversation with your financial professional also. Now you may not be selling your business, but you might be looking to purchase a business, or maybe you're looking to merge with a colleague. You're looking to merge your businesses. How is that going to affect your overall tax picture? By planning that out in advance and being proactive about it, you have the ability to work through options instead of being saddled with the only option because you didn't do any planning in advance. With pass-through entities, you want to do planning in advance so that you understand how much is going to pass through to the owner or owners. So again, there's potential for tax savings opportunities in 1 year versus the next, and so on. Things to think about. More of us are investing in offshore entities or offshore stocks. So you want to think about that too. Are you making any purchases in any foreign investment? So you want to understand what your tax obligation may or may not be with that particular foreign investment. So something to think about also. And when people run into financial challenges, a lot of times the first thing they think or they say or they do is they run to their retirement and they pull money out. So you want to make sure you understand the obligation associated with pulling funds out of your retirement account prior to you being of age. It could be, it's not only penalties and interest for the early withdrawal, but you've also increased your income by that dollar amount that you withdrew, which again, depending on what your financial picture is, you could now be pushing yourself into another tax bracket and therefore overall increasing your tax liability. So different things to think about. The one takeaway from this is be proactive. Do your planning in advance. If you do your planning in advance, it gives you the opportunity to have options. If you don't plan, you get one option. And if you don't do any planning during the year, your only option for taxes in January is to pay your taxes. If you guys have any questions, please feel free to drop them in the chat. We look forward to seeing you every week, and have a fabulous week, and we'll see you next Friday.